Imagine a typical situation. Someone saves up some capital, let's say $10,000 or $20,000. They enter the stock market, buy a couple of hyped up stocks screaming from the news, and a month later, they see a minus 30% on their account. Panic, disappointment, selling at a loss. Sound familiar? This is exactly how most beginners lose their deposits in their very first year. And it's all because they confuse the stock market with a casino and blindly play roulette. Welcome to the channel, everyone. In this video, we'll try to skip the complicated theory and go step by step on how to smartly build your capital. In the next few minutes, we'll discuss the basic mechanics of the market, break down common traps for beginners, and talk about tools that help protect your money, including those that many simply don't know about when starting out. I hope that after this breakdown, you'll find it much easier and more comfortable to navigate market tools. Chapter 1: The Illusion of Chaos. How does the stock market actually work? Let's start with the absolute basics. The stock market is the largest financial system where the buying and selling of company shares takes place. Imagine a successful business that wants to build new factories or introduce advanced technologies. They need a huge amount of money for this. Instead of taking bank loans with harsh interest rates, the company offers a part of its ownership on the open market to attract investments. For example, a business decides to sell 10% of its stake by issuing 1,000 shares. This process is divided into two stages. Primary market, IPO. This is the moment when a company issues its shares for sale to investors for the very first time. Secondary market. This is where you and I spend most of our time. It's the market where investors and traders simply resell these shares to each other. Mechanically, it's very similar to regular markets, where some people bring goods and others buy them to resell later. But why do prices constantly jump around? A stock's price never stands still. It constantly fluctuates, and this is called volatility. This entire giant market operates on the simple law of supply and demand. If investors believe in the company's future, demand grows, which pushes the price up. But stock prices directly depend on news and reports. If a company announces it can't meet its goals or publishes bad financial reports, investors get disappointed, start selling their shares en masse, and the price drops. There are often situations where fundamentally strong companies drop in price due to temporary panic. The crowd sells in fear, but smart investors buy a great business at a huge discount in these exact moments. Chapter 2: Arenas for Giants, NYSE versus NASDAQ. An exchange isn't just a trading floor, it's a reflection of a company's temperament. Trades are executed through intermediaries called brokers, and keeping everything in order is the SEC, the U.S. Securities and Exchange Commission, the main regulatory body ensuring fair operations. In the US, there are two giant platforms: New York Stock Exchange, NYSE, the financial patriarch founded in 1792. This is where large, stable, traditional corporations like Coca-Cola or J.P. Morgan trade. They are known for lower volatility and steady dividends. Historically, tickers, the letter codes of companies, here consist of 1, 2, or 3 letters. NASDAQ, the exchange of the future, founded in 1971 and fully electronic. It's home to the tech sector and fast-growing businesses like Apple, Microsoft, Google. The character of this exchange is high volatility. Tickers here traditionally consist of 4 letters. Remember, being listed on a major exchange is a mark of quality, but it's not a guarantee against bankruptcy. Even giants can disappear. Moreover, if a NASDAQ stock stays under $1 for a long time, the exchange can kick it out to the over-the-counter market, pink sheets, where the risk of fraud is massive. There's also a risk with Chinese companies. By buying their shares on US exchanges, you're actually buying a receipt, an ADR for a stake in an offshore company. A healthy investor strategy is finding a balance between stable NYSE companies and growing tech leaders on the NASDAQ. Chapter 3. The Pulse of the Market. Why do we need indexes? You don't need to check the charts of thousands of companies every day to understand where the economy is heading. That's what indexes are for. They act as the market's thermometers. The most important one is the S&P 500. It includes the 500 largest US companies. This index is calculated by market capitalization, company value, so giants like Apple or Nvidia hold the largest share in it. The locomotive effect applies here. If these giants grow, they pull the entire index up with them, and if they fall, they drag down the whole S&P 500 and the rest of the market's stocks. There is also the Dow Jones, which groups 30 major US industrial companies and is calculated by stock price. To understand the tech sector, people look at the NASDAQ 100, while the Russell 2000 index shows how 2,000 small-cap companies are doing. Chapter 4. The Investor's Toolkit, Stocks and Bonds. What exactly can we buy for our portfolio? 1. Common stocks. By buying this type of stock, you become a co-owner of the business. You have the right to vote at shareholder meetings, and your earnings come from the stock's price growth and dividends. But there is a risk. In the event of a company's bankruptcy, common stockholders get paid at the very end of the line. 2. Preferred stocks. This is a hidden gem of the market, a hybrid between stocks and bonds. They don't give voting rights, but their owners have priority for dividend payouts and during bankruptcy. Almost all of them are issued at a fixed price, par value of $25, and provide a stable income through fixed dividends. Look for cumulative shares. If a company skips a payment due to losses, it will be obligated to pay you all the owed debt later, before paying common stockholders. 3. Bonds. These are debt securities. By buying a bond, you don't become an owner. You are essentially lending money to a company or the government. In return, the company commits to paying you a fixed annual interest rate, coupon. It's very reliable. During a bankruptcy, money first goes to taxes, then to employees, banks, and then to bondholders. The main risks here are interest rate risk. The price drops when the Fed raises rates, and credit risk, default of the company itself. Chapter 5. An investor's best friend, all about ETFs, exchange-traded funds. Buying one or two individual company stocks is a massive risk. Smart investors buy funds, but funds come in different types. Mutual funds, traded directly through a bank or management company, they often have a high entry threshold from $1,000 and high management fees, often above 1 to 1.5%. Exchange-traded funds, ETFs. This is your best tool. What is an ETF in simple terms? Imagine you want to buy one share of all the top 500 US companies, the S&P 500 index. If you bought them separately, you'd need a massive amount of money. An ETF solves this problem. A management company takes a huge sum of money and buys shares of those 500 companies. Then it issues its own shares. By buying just one ETF share, you are essentially buying a tiny piece of the entire economy. Pros of ETFs for a beginner. Instant diversification. If you have 500 companies in a fund and one goes bankrupt, your portfolio will only drop by a microscopic percentage. Low entry threshold and fees. One share can cost from $10 to $500. And since algorithms simply copy the index, the management fees expense ratio are pennies, starting from 0.03%. Liquidity. ETFs trade directly on the exchange just like regular stocks, and their prices change in real time. Cons of ETFs. You don't control the exact makeup of the fund. You can't throw out a company you don't like. And they don't offer super profits. Their goal is stable, predictable growth alongside the economy. Chapter 6. The IPO Trap. Why do beginners burn out there? An IPO is the process where a private company offers its shares for sale to the general public for the first time. Roadshows are held for large funds to gather applications, but for a beginner, this is a trap. Scarcity allocation. Demand often exceeds supply by 10 to 100 times. If you ask for $2,000 worth of shares, you might only get $100 worth. Lockup period. Major investors and employees are not allowed to sell their shares for 90 to 180 days after the IPO. On the day this lockup ends, they massively lock in profits by dumping shares, which crashes the price. Fundamentals. Many companies go public while unprofitable. Make sure to read the S1 form on the SEC website. Look for revenue growth of 30 to 50% a year and ensure the money is going toward business development, not paying off all debts. Hack. The safest approach is to buy IPO ETF funds like the ticker FPX, which automatically buy up fresh public companies, spreading out the risks. You shouldn't allocate more than 10% of your capital to IPOs. Practical section, integrating the strategy into a trading terminal. How do we turn this knowledge into real trades in a terminal, for example, in interactive brokers? Step 1. Portfolio architecture, core and satellites. Allocate 60% of your capital as your core. Buy a broad ETF that will grow with the market and protect you from drawdowns. The remaining 40% are your satellites, individual fundamentally strong stocks to accelerate growth. Step 2. How to buy assets without mistakes. Since ETF and stock prices change every second, never buy at the market order. Use limit orders. You type in the price you are willing to pay, and the terminal will automatically execute the trade during a pullback. Set the parameter to GTC, good till cancelled, so your order doesn't expire at the end of the day. Don't buy the asset with all your money at once. Divide the amount and use a scale-in strategy. Step 3. How to find preferred stocks. They are hidden behind special tickers. On the NYSE, a -PR or a dash is added to the ticker, and on the NASDAQ, it's a fifth letter. In the terminal, enter the company's ticker, hit enter, and select the warrants/preferred section. Attention! Always check the call date. If the company has the right to buy the shares back from you at a par value of $25 after this date, and you bought them on the exchange for $27, you will lose money. Step 4. How to find reliable bonds. Open the bond scanner tool in your terminal. Select the type, corporate or treasury, and the term, maturity. The golden rule for safety. In the rating column, always select only investment grade from AAA to BBB. Anything lower, BBB, CCC, is a junk bond with a massive risk of default. Remember that the minimum lot size for bank US bonds is usually $1,000. The stock market is not a sprint, it's a marathon. Build your portfolio score with reliable ETFs. Use hand-picked stocks for growth, and don't forget about defensive assets. If this breakdown was helpful, be sure to hit the like button, subscribe to the channel, and write in the comments which company or tool you want me to review in the next video. Happy investing!